Hot seat this evening is Kokkie Kooyman from Sim Global, and of course my co-host Chris Hart from Investment Solutions is still with me in studio. Kokkie, great to have you on the program. Thank you so very much. I must say that you look quite calm at a time where we're starting to see a massive storm breaking out globally, and I know that you do have the Sanlam Global Best Ideas Fund, and I know that you have quite a strong global focus across your funds. Are you concerned? Are you worried? What are you doing right now?
A lot of questions there. Am I concerned? I am concerned in terms of the global outlook and how it's playing out. Am I worried about the shares we are in? Generally, no. Although we're getting a lot of sleepless nights at the moment because all the potential knock-on effects, every event sort of means a further deterioration. We can go into that just now. But generally, you are getting superb valuations now, and I know we've been saying this for some time, and we'll most probably say it at the end of next month when markets are 15% lower, possibly. But in this panic selling, and that's what we're seeing in quite a lot of markets now, this is where you're really getting the opportunity. So what are we doing? I have, over the past month, gradually, as we saw the thing just deteriorating further, gotten out of banks specifically where one does see risk. Although they're cheap, there are risks of deterioration, and getting more into other banks, because in the end I run basically the bank side, financial services side, getting into banks that have dividend yields of 6%, have a very good track record of paying those dividends, and are like banks in Sweden, not really affected by the global crisis, but having been sold down 40% as well. So that's more or less sort of, let's say, out of Citigroup, which has a bit of risk, into, let's say, a Swedbank in Sweden where you've got a dividend yield of 6%.
Yeah. Well, I mean, let's touch on the European banks right now, and we alluded to it a little earlier with regards to the systemic risks that could come to the fore. They're increasing the EFSF fund. We know that banks have quite immense exposure to the Greek debt and peripheral Eurozone debt as a whole. What kind of scenario is playing out there? Do you find value in these banks, or do you think there's just too many risks with regards to the possible reward down the line?
Yeah. When we look at our models, in the end, a lot of it is history driven, and we try and calculate what the upside is. Then a lot of the European banks are showing unbelievable upside. Yeah, if this crisis abates, or tomorrow Angela Merkel, Sarkozy, the IMF, the US, and let's say China come together and say we issue a global bond to just take care of 20% of the debt of Greece, Portugal, Spain, Italy, you'll find a lot of shares could literally double overnight. Well, overnight maybe that's a bit strong, but double in the next month, because there is so much risk priced in. But for investors at the moment, we're just staying out of there, because so far the politicians and the regulators have been behind the curve, and every event that they miss triggers a further negative event. For instance, first it was Greece, and they didn't solve the Greek problem quickly enough. Then it spread to Portugal, Ireland. Now it's spreading to Italy, and very many investors are worried about Italian banks. Now the problem is spreading to French banks, because US money market funds are pulling their deposits from French banks, which means the next possible effect is, if there's a run on French banks, the French government has got to bail out French banks, in other words, recapitalize them, which in turn means that France loses its AAA rating, because it's got to go and borrow money to put into its own banking system. The knock-on effect of that is just endless. And at the same time, you've got consumer and business confidence just deteriorating. Now you've got Korea starting to go, because Korea, 50% of its exports is driven by, 50% of its gross domestic product is driven by exports. So if Korean exports start slowing down, okay, yeah. I'm going to talk us into all just selling everything you have.
It's Chris here. Yep, can I just ask, to me, if you just looked at the banks as such, is what you see is what you actually don't really get, is that you would look at something that looks a lot more solvent than you actually get. And there's two squeezes. How I see it is that, for instance, in Spain, you've got banks that haven't really written down the losses that they've got against mortgages, for instance. In other words, their assets, their lending book has been degraded. And then on the other side, their capital base, they're forced to hold government bonds, risk-free bonds effectively as part of their capital. And that is also being degraded. And again, you've got this, how can you say, almost underlying insolvency that some of these banks are facing.
Yep. Yeah, Chris, you put it a lot more, you know, I was getting into the emotion there, but you're putting a lot more rational there, but just as scary. Yes. Because you're quite correct. A lot of the banks, especially the Spanish, well, let's first just focus on them, have got a lot of property exposure which need further write-downs. But the hope is there that the economy recovers, which it won't. So you know that, let's say, 30% of the assets need a haircut, which means the capital ratios are under pressure. But generally, a lot of the banks, the capitalization ratios are still okay, but in a worsening situation, you're quite right, they need more capital. And that's really what frightens the markets, because as the situation is deteriorating, you're getting closer to that point where business confidence just deteriorates, and that you are going to get into a situation where the bad debts start popping up, and then you need more capital.
If I could also add.
Your other squeeze, you're quite correct, is your risk is you've got a liquidity squeeze, because what started happening with the French banks is that your depositors then say, but I'm worried, are my deposit safe? And they start withdrawing their deposits. Yeah. And that's the whole negativity or the risk on banking, because they're geared. Well, so as soon as the bad debts or your deposits start leaving, the gearing goes against you. The gearing works wonderfully in good times. Yeah. And if you had a healthy government behind, let's say in South Africa with Sambo, the South African government could quite easily, look, it still took a bit of pain, but they could step in and rescue Sambo because it was small enough in the economy. But the French banks are quite big, in fact huge compared to the French government, and that's really
this is exactly the issue, is that when they talk about bailouts of the banks and recapitalization, in 2008, when the crisis hit it the first time, governments were a lot stronger. But if the Spanish had to stand behind their banks, with what are they going to stand behind their banks? What are the Greeks going to stand behind their banks with? There's nothing. The cupboard is empty. Well,
Kokkie, if I could just interject there as well, and maybe just tell us what banks you're comfortable in terms of having exposure to right now, because not only in Europe, but the US as well, because we've got this endemic issue and it's called debt and it's across the board, right?
Yeah. So you're trying to avoid, unless you're very risk-taking. I mean, for risk takers, this is great, because if something turns positive, you can make a lot of money. But most of us shouldn't take this type of risk. If you want to avoid risk, you want to avoid two types of banks at the moment. Firstly, you want to actually avoid any European bank. You just don't want to be invested in a European bank at this stage, because the contagion risks, and they all have exposure.
Do you have exposure to any European banks, Kokkie? Any at all?
Yep. I wouldn't. Well, we're not in any European bank at this stage. The second one, and I'm talking core Europe, I'm excluding obviously Nordic Europe, Scandinavia from that. The second one is you actually don't want exposure to investment banks, and that's why I alluded earlier, we still held a bit of Citigroup, because Citigroup is very cheap. But you know, you just don't know on the investment side and on the balance sheet what type of exposures they have to Europe or to trading positions. And so in the US, for instance, there's a very good bank. Warren Buffett holds a fair chunk of it as well, US Bancorp. Interesting, if you go and look at the share price, US Bancorp, it's held up very well, especially recently compared to, let's say, JP Morgan or Citigroup, because US Bancorp has very little investment banking, almost none. It's a very well-run retail bank. It's very well capitalized. It's strong. So it's going to be affected by the US slowdown, but not really that much by global events. Yeah, so you are getting a lot of banks like that where you can be discerning, say there's no investment banking risk, there's also no funding risk, and there's also no bad debt risk. And there are a lot of them that are actually holding up fairly well.